But so if you look at how infrastructure assets are valued, which is really, well, in fact, how all assets are valued, is you look at the future cash flows and you discount it by the cost of capital. And so the more certain those future revenue streams can be, the lower the discount rate. And lower discount rates reflect in two things. They reflect in lower cost of debt, and they reflect in lower returns to shareholders, because shareholders demand a lower return for less risky assets. But you usually find that the upside from higher gearing offsets that, because the more certain your future revenue, the more debt the vehicle can support. And so you need less equity than its similar active business. And so that allows you to effectively buy more revenue for the same price. That's the upside. The downside is that when interest rates go up, the cost of capital goes up, and so more of your cash flow is used to pay for debt. So there's less cash flow for equity, and because the risk-free rate's gone up, investors demand more return, so the value of your stocks falls. So they are interest rate sensitive stocks, but importantly, it's real interest rates that are effective, because the revenue goes up with inflation. So it's really where interest rates move up, but inflation doesn't. So increases in real rates are bad for infrastructure, whereas decreases in real interest rates are good for infrastructure.